Okay, in Chapter 6, we're going to start looking at internal control and how we deal with this thing, internal control, in a financial statement audit. So, first of all, internal control is the responsibility of management. They should maintain controls that provide reasonable assurance that there's controls in place and that they're being followed. The internal control system should ensure that assets and records are safeguarded. That's probably one of the number one elements of internal control. And they generate reliable information for decision making. We as the auditor need assurance about the reliability of the data generated by the information system, and a strong internal control system provides good information. Now, the auditor, us, uses risk assessment and risk assessment procedures to do a couple things. We're trying to understand the entity's internal control. What kind of procedures do they have in place? What do they do to safeguard the assets and the records and ensure that they're being recorded correctly? Identify key controls. Recognize the types of potential misstatements that could happen. And then we design tests of controls if we want to rely on internal controls, and substantive procedures, whether we want to rely on internal controls or not. And we're going to talk more about those. The auditor's understanding of the internal control is a major factor in determining the overall audit strategy. So it is our responsibility to obtain an understanding of it and assess control risk that was talked about back in Chapter 4. So that's an overview of who's responsible for internal control and what our responsibilities are as an auditor. Now let's take a look at what exactly internal control is. And COSO, that's an acronym, and Committee Office, I forget what it stands for. I used to know, I don't remember now. But they were a group that got together and said, okay, what's good internal control? First of all, the objectives of internal control are to provide reliability of financial reporting. There's going to be effectiveness and efficiency of operations and compliance with laws and regulations. And included in that is safeguarding of assets. Generally, internal controls pertaining to the preparation of financial statements for external purposes are relevant to our audit. Okay, so we're looking at these things because they affect the financial statements, hence they need to be part of our audit. Now, the potential benefits and risks to an entity's internal control from IT perspective. IT is a huge component of a company nowadays. Okay, so we need to audit that. Some benefits for internal control from IT. There's consistent application of predefined business rules and performance of complex calculations because they're automated in processing large volumes of transactions. There's greater timeliness, availability, and accuracy of information. Facilitation of additional analysis of information for enhanced internal decision making. So you're getting good information quickly. Greater ability to monitor the entity's activities, policies, and procedures on a timely basis. There's a greater ability to prevent or detect circumvention of controls. An enhanced segregation of duties through security controls in applications, databases, and operating systems. What does this mean? Well, when it's manually kept, you have to protect the books. You have to safeguard those, lock them up somewhere. In a computer system, you use passwords and securities, fingerprinting, passwords, to protect areas that someone should not have access to. Some of the risks, though: reliance on systems or programs that, unknown to management, inaccurately process data, processing inaccurate data, or both. There's not authorized access to data that may result in destruction of data. So if somebody does get somebody's passcode, they could get in there and alter the data. Unauthorized changes to data in master files. Unauthorized changes to systems or programs. Even the people with the passwords may go in and make these changes without authorization. Failure to make necessary changes to systems or programs to update them. Inappropriate manual intervention. We call that the override key, right? And potential loss of data just from being in a computerized environment. Okay, so there's a lot of risks associated with an entity's IT and what we're looking for with internal control. That's just an example. So when we're in internal control, what are the key components of it? What makes a good internal control system? Information and communication, the control environment, how well the entity's risk assessment process is, what type of control activities a company has, and how they monitor the controls. So let's take a look at these. The control environment is simply the set of standards, the processes and structures that provide the basis for carrying out internal control across the organization. Who is it? It's the upper levels of management and the board of directors. They project to the company the control environment, and we call that the tone at the top. If they feel internal control processes and procedures are important and communicate that, then you'll have a strong and good control environment. But if it's more lackadaisical towards these, or if there's a lot of management overrides and ignoring procedures, then we have an issue. So that control environment is not as strong. In the auditors, we will be looking at this control environment. The entity's risk assessment process. So this is where the entity is always looking, identifying and analyzing risks that may occur to achieve their objectives. And during this process, they need to determine, how do we manage these risks so we can meet our objectives? So management is considering all the possible changes in those external environmental factors and within its own business model that may impede its ability to achieve its objectives. And I know when I teach this in an intro accounting course, I'll just say, like, think of the risks an airline has. External risks. A crash, right? Hope nobody's flying. I always say that and somebody goes, I'm flying next week. A crash, though, which a mechanical failure, a terrorist attack anymore, right? Within the company, and their IT system goes down. We've seen that with airlines. So it's these kind of risks that the company is trying to identify and having an action plan in place to circumvent them and to make their impact on the company achieving their objective as low as possible. The information and communication. Now, information is necessary. We know that, right? So the entity needs information to carry out all their responsibilities to achieve their objectives. Communication occurs both internally and externally, and this provides the organization with the information to carry out their day-to-day internal control activities. So communication enables personnel to understand their responsibilities and the importance to achieving them. So a company, their information system and communication system is a strong component of their internal control. Control activities. Now, control activities are the actions established by the policies and procedures to make sure that management's directives to mitigate risks and achieve the objectives are carried out. Control activities are performed at all levels of the entity. This isn't an accounting thing. The person working the cash register at Walmart is part of control activities at Walmart. They just use their drawer. They have a key. They can't give a credit. Somebody has to go over to customer service to do that. They can only open their drawer when there's a sale. All these little procedures are part of the control activities. And in auditing, we may choose to, as in a private audit, rely on these control activities if we feel that they are strong. In public auditing, we have to look at their control activities. And then monitoring. Is there ongoing evaluations are going on? Separate evaluations, usually internal audits and external audits. And any findings are evaluated and communicated so that senior management and the board can make changes where necessary. Okay, so those are our 6 components or 5 components of internal control. A strong control environment, risk assessment occurring, good control activities, we have information and communication that's strong, and we monitor our activities and make changes when necessary. And when I say we, I mean from the company perspective. Now, these principles are on page 183, and they're the 17 principles underlying the components of internal control. So we're going to take a look at these, and they're broken down by each component of internal control. And so as an auditor, we need to understand these 17 principles. In a control environment, what are we looking for? The organization demonstrates a commitment to integrity and ethical values. That will just make the company stronger. The board of directors demonstrates independence from management and exercises oversight of the development and performance of internal control. So they are watching management instead of just going along with management. Management establishes, with the board of directors' oversight, structures, reporting lines, and appropriate authorities and responsibilities in the pursuit of objectives. So they segregate duties, they give a line, or I should say, everybody has their own specific duties, they're written down, things of this nature. The organization demonstrates a commitment to attract, develop, and retain competitive individuals in alignment with objectives. So we want to make sure that when we're hiring people, they're ethical. They are, what's the word I'm looking for? I'm sorry, it just went out of my mind. That happens a lot lately. I don't know why, but they are competent. That's the word I was looking for, competent. They know what to do, and we train them as well, meaning the company. The company is training them. The organization holds individuals accountable for their internal control responsibilities in the pursuit of objectives. So a lot of times, companies that have good control environments will make their internal control responsibilities of an employee part of their evaluation process. That's just an example. So the control environment has to have these principles. Now, the next thing we'll be looking at is the entity's risk assessment. Business risk can arise or change due to some of the following circumstances. There's a change in the operating environment. Maybe there's a corporate restructuring, new personnel, new technology, or just international growth, rapid growth. There's a new accounting pronouncement, There's a newer revamped information system, new business models, products, or activities. So the risk assessment process should consider external and internal events that may arise and adversely affect the entity's ability to begin, record, process, and report financial data to meet the financial statement assertions that we talked about in the last chapter. So what specifically? The organization specifies objectives with sufficient clarity to enable the identification and assessment of risks relating to objectives. That's number one. The organization identifies risks to the achievement of its objectives across the entity and analyzes risks as a basis for determining how the risks should be managed. So they're actively looking for documenting and evaluating risks. The organization considers potential for fraud in assessing risks to the achievement of objectives, and that's always present. The organization identifies and assesses changes that could significantly impact the system of internal control, and they're addressing them. So not only are they identifying them during this process, they are also addressing them. So those are some of the specific principles in risk assessment. As auditors, we're looking to see this is what's occurring within the company. Control activities. The organization selects and develops activities that contribute to the mitigation of risk. So it tries to prevent the risk or lower the risks so that the objectives of the organization can be could come to fruition, could be achieved. Things like performance reviews. We want to make sure that people are doing their, working towards goals that have been set up that are part of the, reaching the objectives of the company, giving feedback, changing goals. And we, again, is the company. Physical controls. There's locks on items. There's passwords. Okay. Segregation of duties. There's not too much power in one position over an asset. So we don't give one person, or the company doesn't give one person all of the cash duties. It's separated among as many people as it can. Information processing controls. These are things like the passwords. So these are some examples of the things that a company should have in place in this area. The organization selects and develops general control activities over technology. So specifically the technology. Things like having an off-site storage and an on-site storage. Protection of the computer system and databases and all themselves with locked offices. Only certain individuals are allowed near them. Passwords, firewalls, encryption, etc. So to achieve good control activities and protection of your IT and technology, these are some things we would be looking at. The organization deploys control activities through policies that establish what is expected and procedures that put policies into action. So basically, we're saying here that the company has said, we have these objectives. These are the policies we have in place, some general rules about reaching these objectives, and these are the specific procedures in place to that flow out of those policies. Auditors are looking for that in a company. Information and communication. The organization obtains or generates and uses relevant quality information to support the functioning of internal control. So they identify and record all valid transactions, some specific things, classify them properly, measure the value of them properly, record them in the proper period, and properly present transactions and disclosures. That's our accounting system. So it will have a good accounting system. The organization internally communicates information, including the objectives and responsibilities for internal control. necessary to support the functioning of it. I used to work at the New York Times years ago. Actually, I worked at a division, WNEP, and I wasn't part. I was the accountant there, but I did deal with the internal auditors, which all public companies have internal auditors, constantly assessing risk, determining how controls are working, internal controls. Are they appropriate and are they being followed? And I've experienced from the internal auditor side, these, the auditor looking and us making sure we're following these principles. The organization communicates with external parties regarding matters affecting the functioning of internal controls. Okay, so whenever that is necessary to have an independent appraisal of the functioning of the internal controls, it's being done and it's being communicated. Monitoring. The monitoring of controls is a process that assesses the quality. The organization selects, develops, and performs ongoing or separate evaluations to ascertain whether the components of internal control are present and functioning. There's your internal auditors. External auditors are doing that as well. What are the internal controls? That's great. They're all written down. Now, are they functioning? Are they being followed? The organization evaluates and communicates deficiencies in it in a timely manner so that it can be dealt with. Okay, so these are drilling down into these different components of internal control to really say, here is, the COSO came out and said, here's what needs to be in place, companies. Okay, so that's the company perspective. Now we're going to go in the audit perspective. So that's what the company should be doing when it comes to internal control. Every process has its own specific internal controls. So the cash collection process, the cash payment process, the purchasing process. Okay, so throughout the rest of the book, when we start going into the different business processes, then we'll address the internal control for that particular item. This is general overview. Remember the audit risk model. So when we start planning our audit strategy, we have our audit risk model. Audit risk equals that inherent risk. It's just risk due to the type of an account we're looking at and the chance of it being misstated. Control risk. That's the risk that internal control won't stop a material misstatement or an error. And then detection risk. That's the risk as an auditor, we won't find a problem with a procedure or an account. So we, based on our experience, need to determine each of those, and those multiplied together provides us with our audit risk. Now, how do we determine control risk? This is on page 190 of your book. Okay, so the considerations of internal control and its relation to substantive procedures. So that's our first step when we're going to start an audit and look at a process. We have to develop an understanding of an internal control by evaluating the design of controls over that process and determine if the controls have been implemented. So somebody can hand us a book and say, here's how we collect cash, but we have to make sure that's how they collect it. We then document the understanding. Okay, so we write it all down. Here's what it is. We're going to talk more about how we do that. The next question is, does the auditor intend to rely on controls? Meaning, are they going to rely on them? They feel they're strong enough to prevent a material misstatement. The reliance strategy, if we do, then we have to test those controls. So we plan and perform tests of controls, and then we set control risk based on the results. The next question, does the achieved level of control risk support the planned level of control risk? If the answer is yes, then we document the level of control risk. If the answer is no, we revise a plan level of substantive procedures. So we're all about testing and auditing. It boils down to this. We're going to look at a company's internal controls and say, boy, they're pretty strong. We're going to rely on those. But let's test them just to make sure we can rely on them. If we test them and we feel we still can rely on them, there's less substantive tests we need to do in our audit. If we don't want to rely on them at all, or feel that we're still going to have some control risk related to them that's not appropriate, it's higher than what we wanted, then we'll just have more substantive tests than what we originally planned. And that's what this flow chart is saying. Now, the substantive strategy is what we're just saying. After obtaining an understanding of internal control, the procedure, the control environment, the information and communication related to that, maybe that process, an auditor may choose to follow a substantive strategy and set control risk high, meaning there's a lot of risk in the internal controls. If we rely on those, there's a lot of control risk. There's a chance the internal controls won't stop an error. So, okay, there we go. Controls do not pertain to an assertion. Controls are assessed as ineffective. Testing the effectiveness controls is inefficient. So either we just can't test the control to feel comfortable with the control risk, there are no controls, okay, or they're not even related to an assertion of management. So we rely more on substantive testing, which we'll talk about. The reliance strategy says we obtained an understanding of internal control. We're going to rely on these internal controls, and we feel the control risk is at a lower level. We feel that basically there is no risk that the internal controls won't stop an error from occurring. They're really good, they're really strong, and that control risk is low. Okay. So here are our assertions we're talking about. Remember these? Assertions about classes of transactions and events and related control procedures. So remember we said the internal control doesn't support an assertion, or the assertions aren't present. Occurrence. So we're looking to see, is there segregation of duties in that process? Are there pre-numbered documents? Is the information reconciled? Completeness. Are all the pre-numbered documents accounted for? Segregation of duties again, and reconciliation. Is there accuracy? Things we're looking at. Internal verification of amounts and calculations. General and specific authorization of transactions at important control points. So within the internal controls, is there authorization? Is there proper cutoff within the internal controls? Procedures for prompt recording of transactions, internal review and verification so that the recording of documents is properly cut off at the end of the year. And classification. Is there a chart of accounts? Okay, is anybody reviewing and verifying how things are classified? So these are the assertions. That's the control activity. If these types of control activities aren't present, then the internal controls don't support an assertion. Okay, so just to review that component. The auditor should obtain an understanding of the 5 components in order to plan the audit. This knowledge is used to identify types of potential misstatement, the risks of material misstatement, and then how they will design controls and substantive procedures. So a general overview of all internal control should be made, an assessment of it, of those 5 components. Remember the 17 principles. What are we looking for? So when we get an understanding of the control environment, we get an understanding of the entity's risk assessment, we understand the information system and communication, control activities, and monitoring of controls. And we're looking to see if those 17 principles are present. That's when we can feel more comfortable about moving forward with how we will audit different aspects of the company. Now, I'm kind of going ahead of myself here, but that's okay. This is on page 194 of your book. Just checking out my notes that I want to bring to your attention. On 194, and we talked about this in the last chapter, auditors just don't start with a blank piece of paper. A lot of times we have audit programs. They could be pre-printed audit programs from a company that helps us through our audit process. They may be internally created. But one document we may use is a questionnaire, okay, within our audit program and process. So this is an example of a control environment questionnaire. Remember, we're going to put the entity's name, the balance sheet date, who completed it. And here's a typical type of documentation: communication and enforcement of integrity and ethical values for earthware. The effectiveness of controls cannot rise above the integrity and ethical values of the people who create, administer, and monitor them. Integrity and ethical values are essential elements of the control environment, affecting the design, administration, and monitoring of other components. Integrity and ethical behavior are the product of the entity's ethical and behavioral standards, how they are communicated, and how they are reinforced in practice. Okay, so that is what's important about integrity and the ethical values of earthware. Now, in the audit questionnaire, to support that, we ask these questions. Have appropriate entity policies regarding matters such as acceptable business practices, conflicts of interest, and codes of conduct been established? And are they adequately communicated? So there's policies out there. Every company has them. In this case, the answer is yes. The permanent work papers contain a copy of Earthware's conflict of interest policy. Great. Does management demonstrate the appropriate tone at the top, including explicit moral guidance about what is right and wrong? The answer is yes, according to the auditors. Earthware's management maintains high moral and ethical standards and expects employees to act accordingly. Our everyday dealings with customers, suppliers, employees, and other parties based on honesty and fairness. So would be given this in a questionnaire, we would then find the answer. Earthware's management maintains a high degree of integrity in dealing with customers, suppliers, employees, and other parties. It requires employees and agents to act accordingly. And we would have policies to support this. Okay, so those are some example, or just an example of a questionnaire that we would use in an audit to assess this internal control. Okay, so we would document that through the questionnaires, procedure manuals and organizational charts, flow charts, internal control questionnaires like the one we just saw, and then descriptions, our own narrative descriptions. Now, procedure manuals and organizational charts would be provided by the company. Flowcharts, auditors love flowcharts. It's a picture. This is where we create a picture of the accounting system, and that will help us assess the strength and weakness. Take a look on page 197 of your book. Here's an example of an order entry portion of the revenue process. Okay, now these symbols are defined later in your book, but these symbols do have general meanings. For instance, where it says customer order, that symbol is a document. So it says the customer order entry department starts it. The by phone, mail, or email from customer service rep. Customer order. The order is then put into the system or displayed. That's a display. The display or the input then goes through what we call a data validation program. And a data validation program is just making sure that it's within a certain range. There isn't anything funky or not appropriate. It then goes through a shipping program. Now, in the data validation, if there's an error that comes out of this, an error report is made, someone manually fixes it and puts it through the system again. If it passes the data validation program, it then goes as an order. Now it goes into the shipping program. And the squares represent a process function. The shipping program will then send out for an approved shipping order, which is a document. That's the symbol for a document. The goods would then be shipped. That symbol is a manual operation where it says ship goods, and then an approved shipping order is complete. So we can understand how order entry occurs from the order from the customer, ultimately shipping to the customer through this flow chart. And that's what auditors develop that from information they collect during this understanding of internal control. Now, the basic concepts of the 5 components should be present in all entities. Okay, they're more formal in large entities. They're required to be written down. They're following all the rules. But in smaller or mid-sized entities, they're less formal and maybe not as strong. And I've experienced that. I have audited many small companies, and they do lack internal control from the ones that I saw. Not because they don't care about it, but because they don't have enough people and time to create a system that's perfect. Now, what are some limitations on a company's internal control? What won't it stop? It won't stop management from overriding. My favorite description of this is when you're at the supermarket and the checkout cashier says, "Oh," and they yell over to the manager, "I need to do a correction. What's your code?" And then the manager yells their code over. Like, why bother? Why bother having a code? Not only does all the employees know the code now, but so do all the customers. Okay, so that's what we're talking about here. Management goes in and overrides. It takes out a procedure. Keep your code secret. Not anymore. Human errors or mistakes, they're just natural. And then collusion, more than 2 employees, or more than 1 employee, I should say. More than 1 employee will work together to circumvent the internal controls. So those things cannot be prevented. So here's some primary internal control weaknesses observed by certified financial examiners. Okay, a lack of internal control. So this is over a 3-year period, it looks like. The darkest being 2014. Lack of management review. Remember, we need authorization. Override of existing internal controls. Poor tone at the top. Lack of competent personnel in important roles. Lack of independent checks and audits. Lack of employee fraud education, and lack of clear lines of authority. Okay, so there's a couple different reasons, but it looks like our largest one is a lack of internal controls. So assessing control risk, we have to identify specific controls that we can rely upon. Perform tests of those to make sure that they're operating the way they should, and then conclude on them. So, some of the common ways that auditors perform tests of control. We ask questions of appropriate entity personnel, people who know this stuff. We inspect documents and indicate the performance of the control. Is it according to, the personnel and the procedure book, this is what should be happening, and let's inspect the documents to make sure. We observe the application, so we watch the company perform the process, or we re-perform it independently and see if all of the steps are being followed. Once we do this, then we could document the achieved level of control risk. So the auditor's assessment of control risk and the basis for the achieved level can be documented using a structured working paper, an internal control questionnaire, or memo. So here's another example for earthware. This will show us how the control risk for two accounts that differ in terms of their nature, size, and complexity is documented. Inventory. Inventory is 122,337,000. It's considered a material balance. It has a lot of transactions. Significant inherent risk related to overstock, aid, out-of-style products, just from the nature of the inventory. And there's a lot of complex computer processing involved. The extent of understanding needed to plan the audit. We need to understand the entity control environment, the entity risk assessment, how they monitor activities. We need to know about significant classes of transactions, policies about inventory pricing, the initiation, processing, and recording of transactions, what exactly occurs, and then control procedures that we can rely upon. So after looking at this, we decide control risk is assessed to be low because tests of controls conducted on relevant controls in the purchasing and inventory cycles were consistent with the planned assessment of control risk. So what this is saying is we did some work here. We checked out what they said. So we got an understanding of it, and then we did some control tests, and that's what we determined. What will we do as far as our substantive procedures? Well, since we assess this to be low, we're going to do some physical examination of inventory and then information technology assisted audit techniques to audit the inventory compilation. Okay, so we're going to do a few more things, but we feel pretty comfortable with it. On the other hand, prepaid advertising. It's a significant balance. There's only a few transactions. There's little or no inherent risk because there's not a lot of transactions in it. And it's very simple. So we're going to look at the extent of understanding needed to plan the audit, the control environment, what's in the account balance, and monitoring of activities. For this one, it was determined control risk is assessed as high because there are few transactions and the procedures for amortizing advertising expenditures are simple. So it's okay to do a substantive strategy here to feel more comfortable with the balance. You don't have to rely on controls. So substantive procedure, we're going to recalculate, we're going to reperform and make sure the amortization of the advertising expenditures is appropriate, and that'll be fine for this account. It's just the route these auditors are planning on taking. When you perform substantive procedures, so now we're looking at audit strategies for the nature, timing, and extent of substantive procedures based on different levels of detection risk. So, if low detection risk, one strategy would be to physically examine the inventory at the end of year, make sure what they say they have, they actually have, review external documents for cutoff information. You may want to confirm with consignment, and you may want to re-perform. Timing. All significant work is completed at year-end. Extent, extensive testing of significant accounts or transactions. What if high detection risk? If there's a risk, a high risk that we won't detect a material misstatement. Well, corroborative audit tests using the following types of audit tests. We physically examine not only at year-end but also at interim date. We have analytical procedures in place to start looking for those large variances, things we're not comfortable with. and then we complete substantive tests of all the transactions and balances. We'll do this at interim dates and year end. So low detection risk, just year end. High detection risk throughout the year and year end. The extent limited test of accounts or transactions. So the timing of audit procedures. They're done at interim dates or year end. Okay, and here's another example for earthware clothier. So you're just not auditing at year end. You may be doing it throughout the year. And here you go. The beginning of the year, we may accept the audit. We understand the entity and its environment and start planning the audit on May 31st. July 31st, we do some tests of controls and their financial statement date, and that's going from July through November, right? Through November through February, now we're doing our substantive tests because now that's when the financial statement is coming through. So I don't want you to think an audit is we just take our briefcase, go in for a day, and we're done. Especially large companies, some auditors are there the whole year. So what are some interim tests of controls where we're testing the internal controls? The assertion being tested is not significant. Control has been effective in prior audits, so there was no problem with internal control. And there's efficient use of staff time. That's when we can do interim tests of controls. Interim meaning throughout the year. Interim substantive procedures are done on the control environment. They're done on the availability of information, the purpose of the substantive procedure. That's when we would determine which test to do. The assessed risk of material misstatement, the nature of the transaction, and the ability of the auditor to perform appropriate procedures to cover the remaining period from when they tested through the end of the year. So this is where we determine what type of procedures we would do for test of controls and substantive procedures. These items would be looked at. Give me a timeout 1 second. When we're auditing accounting applications processed by service organizations. So we may go into a company and audit them and they say, oh, we don't do our own payroll. Paychex does it. So in some instances, an entity may have some or all of its accounting transactions processed by an outside service organization, right? So because the entity's transactions are subjected to the controls of that organization, Paychex, that's a concern to us. One of the auditor's concern is the internal control system at Paychex. So it is not uncommon for service organizations to have an auditor issue one of two types of reports on their operations. And here they are. Type 1 describes the service organization's controls and assesses whether they are suitably designed to achieve internal control objectives. Type 2 takes it a step further, and it provides assurance on the operating effectiveness of that service organization's controls based on the auditor's tests of controls. Okay, so now as an auditor, we're looking for these reports. An auditor may reduce control risk below high only on the basis of a service auditor's type 2 report. So you don't get type 2, it's assessed at high. Now, if there is a material weakness, what is it? It's a deficiency or combination of deficiencies in internal control, such that there's a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected through internal control. A significant deficiency is a deficiency or combo of deficiencies in internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance. So these are some results we would want to communicate during our audit of internal controls. We see a material weakness. That's what defines a material weakness. We see a significant deficiency and we need to correct it. So this would be communicated to the audit committee, okay, and make sure it gets corrected. So here are some examples of control deficiencies, significant deficiencies, or material weaknesses. So here's some deficiencies. Inadequate design of internal control over the preparation of the financial statements being audited. Inadequate design of internal control over a significant account or process. Inadequate documentation of the components of internal control. Insufficient control consciousness, so people don't understand controls. Absent or inadequate segregation of duties. Absent or inadequate controls over the safeguarding of assets. So these are deficiencies. Inadequate design. So these are deficiencies in the design of the controls. Again, inadequate design of information technology app controls. Employees or managements who lack the qualifications and training to fulfill their assigned functions. Inadequate design of monitoring controls. And the absence of an internal process to report deficiencies in internal control to management on a timely basis. So basically, they're violating the principles. There's nothing in place to assure us the principles are being followed. If you look through that list, that's exactly what it is. Failures in the operation of internal control are different. Failure in the operation of effectively designed controls over so people aren't doing what they're supposed to. There's a failure of the information and communication component to provide complete and accurate output because of deficiencies. So a deficiency could cause a failure. Failure of controls designed to safeguard assets from loss, damage, or misappropriation. So someone isn't following the rules there. A failure to perform a reconciliation. Undue bias or lack of objectivity by those for accounting decisions. Misrepresentation by entity personnel to the auditor. Ooh, that's not good. So this is failure in the operation of design controls. Management override or controls. Like I said, the person yelling, "Here's my code," Failure of an application control and an observed deviation rate that exceeds the number of deviations expected by the auditor. So you expect there to be 1 or 2 failures, and there's 10. Well, that's what we're talking about there. Okay, so those are the different types of things we're looking at. And when we find them, they must be communicated. Now, what kind of controls are there in an IT environment? And this is a little bit, they call this like the appendix, right, of your book. It starts on page 205. So the advanced module, general controls, the data center, and network operations. And it goes in and explains each one of these. So the data center and network operation controls include controls over computers and networks, data prep, workflow control, and library functions. Okay. The system software acquisition, change, and maintenance. Is there a process that goes through? Is it all documented? Access and security controls. Are there physical protection of computer equipment, software, and data? What happens with loss of assets and information through theft or unauthorized use? Are we protecting them to prevent that from happening? So these things would be like locked buildings, only access for certain individuals in certain areas, limiting people's ability to get in certain parts of the computer software. Application system acquisition, development, and maintenance. Again, the company should have written policies and procedures for planning, acquiring, or developing and implementing new systems. There should be feasibility studies. They usually do a parallel run, the old system and the new system, to make sure the new system is working. Are there flow charts? Is it detailed out? Okay, and good controls, good internal controls will have these types of items over IT. Application controls. The first one being data capture controls. They ensure that all transactions are recorded and transactions are recorded only once. Rejected transactions are identified, controlled, corrected, and re-entered into the system. If you think back to that data validation we saw in that flow chart, that's and that's data validation controls, but that's along the lines of what we're talking about here. Okay, so there are three ways of capturing data in an information system: source documents, direct data entry. So the source document goes right through the system, data entry into the system, or combo of the two. Okay, so you could read through that to learn more about it. Data validation checks for outliers. It puts information in about the limits of a particular type of transaction, high limits, low limits, and things that fall outside of these limits are then called errors and re-examined. Are there processing controls, output controls? What happens with the reports? Are we protecting those, making sure only certain people see those? And then error controls. What happens when an error is detected? How is it fixed? Okay, and there's some tests on data validation controls, as I said, limit tests, range tests, sequence, etc. So there's all kind of, and if a IT system has this, you could feel pretty comfortable about the internal control around it. Finally, there's our flow charting symbols. As I said, we love to do flow charting in auditing to see a process, and these are what the symbols represent normally. So you can use these symbols and go on back to that flow chart we had on the other page, and you can start lining them up. I think this is a great page just to always keep with you. This is like a key page from auditing so that you always can reference this when you may have to do a flow chart. Okay, so this was our chapter introducing you to this concept of internal control, where we first looked at what it even is. What are the company's responsibilities related to it? And generally, as auditors, what do we do with regards to it? How do we assess it? How do we establish control risk? And then once we establish control risk, what kind of tests do we do from that point? Now, it was a general overview. As I said, as we get into the various chapters, we're going to look at test of controls for specific processes, you know, check disbursement, cash receipt, purchasing, payroll, etc. So don't think if you're sitting there going, I don't know all this stuff. You're not going to. It's just an introduction, get you familiar with the terms, try to make you understand the flow of how we go through and determine risk. And then this sets us up to conduct the audit. Remember, we're still in with our planning. I'm taking you back way back to chapter 1. Actually, we could look at it at chapter 5. We finished planning the audit. Now we're considering and auditing internal control. So in chapter 6, we introduce you to it, and in chapter 7, we'll continue to look at it. Okay, so that concludes chapter 6's lecture. If you have any questions, please email me, and thank you.